Hello and welcome to Car Dealer Live. My name is James Batchelor. Now, today, Black Horse is joining us to chat about various factors that are affecting the motor trade at the moment. And we'll be talking about dealer profits, rising prices, rates, and how dealers can improve customer retention. Joining me is Paul Hyne, Black Horse and Lex Autolease Commercial Director, and Preston Rogers, Black Horse's Consumer Distribution Director. Hello, gentlemen.
Hello.
Afternoon.
Hello. Hello, lovely to have you both on. Thanks for coming on to Car Dealer Live today. Um, as always, lots to talk to you about. But let's just start with something that is very, very current. We've been reporting a lot of this over the past few weeks here at Car Dealer, and that is, of course, Dealer Group 2023 accounts. So, Preston, can I just turn to you first on this? Um, why do you? Firstly, a lot of these accounts they've been showing drops in profits. In some cases, big drops in profits. Why would you say that is?
So I think there's a couple of factors there. I think one is it probably reflects the more difficult market, particularly in the second half of 23, where probably stock write-downs became a normal thing. Where I think that was probably 20, that was normal stock stock trading for 2017, 18, 19, and probably hadn't had to happen. I remember having conversations with dealers. They were saying, actually, I've got to start writing my stock down again because it's actually depreciating. So some of that is probably a bit of a normalizing effect. I think dealers had to be very selective about the stock that they picked. I think another factor is that higher prep costs have crept in, particularly in the older used space, where the sort of heartland, the 1 to 3 year old used car, probably wasn't there in great numbers because of that COVID new car supply crunch. So I think dealers were having to face higher prep bills. We saw that manifest in some vehicle quality issues. So people had to face into that. They had to put the cost in. I think that hurt profitability. But I think in some ways, I think it's just a normalizing effect. I think 2021 and 2 were a little bit abnormal. And I think it's some of that's just the bumper profits have left a lot of the businesses. And I think you could probably draw parallels to OEM profitability. If you had to look at OEM results in particularly 22, where supply came back, good demand. Some of those have also moderated. In 24, it's moderated to a greater degree, and probably shows that demand hasn't held up quite as well, and supply is now back. So that's probably what I'd say. Paul, I don't know if you'd add anything to that.
No, nothing to add. You've covered everything there for me.
But also because I've been covering quite a lot of these stories, and of course it's very easy to say huge profit losses, but for quite a lot of businesses, they've used those bumper profits and they've been reinvesting in their businesses quite a lot and expanding as well. So it's not quite as it's a bit nuanced, isn't it, Preston?
Yeah, and I think expansion is tricky because if you look at what's happened, particularly in the used car space, where you've seen some closures of big sites. Expanding in used cars, I think it's always been a timing thing about when you take on bigger sites, because you need stock to be there to sell. Especially these big showrooms take stock to feed. And I've spoken in my team. There's one person's leftovers are another person's riches, and you do find that when some of these sites have come up for sale, they've been snapped up. So clearly, different people take different views of the market. The franchise world, I still think shows probably a bigger consolidation. That continuation of slightly less rooftops is carrying on. So I think the reinvesting, sometimes is to almost take a bigger share of the market where maybe one or two sites are closing. But they have to do that firstly to meet franchise standards or to just remain competitive in the used car space. And some of that reinvesting is also in the digital capability. So we've seen businesses, that's a continuation after COVID, businesses having to be sharper to compete with those digital players, whether that's new car direct, agency or some of the traditional online players.
Yeah, yeah. Some of the dealer group accounts that came out, obviously there was a bit of an outlook as well for those businesses, outlook statements, and quite a few dealer groups were saying that so far this year, the first half H1's been a bit tough, but there are higher hopes for a more profitable second half. What do you think the forecast is for the remainder of the year? Do you think it's a slightly more positive picture?
Yeah, so maybe I'll start this one off, and then Paul can comment on the used car market, which I think is a huge piece of the puzzle there. Um, I think what we do see is cars are selling fast. So I do think while things are difficult, I think a lot of the write downs, people with some wrong way around stock, I think some of that is now gone, are now gone from the market. And I think whilst the market is tough, I think it's not, other than certain pockets which we probably know about, and you probably talk about in a lot of your content. But I think things are probably, even though 2017, 18, 19 felt tough, and very, very competitive, it got quite predictable. It was really, hyper competitive, but you knew where you were, you knew what you needed to do to transact the deal. So in some ways, I think it's also just that case of everyone understands where the biting point is now, which is probably why it's easy to get your business into that sort of shape. But I do think the used car market is probably the biggest impact. So Paul, I don't know if you want to maybe talk through that.
Yeah, definitely. I'd certainly agree that the outlook is more positive than we saw the first half of this year. A lot of uncertainty in the market this year. Changing government, elections, all those sorts of things. Inflation's still running quite high, but the market remains a little bit more positive, I would say. On the used car front, the supply of 0 to 5-year-old cars is about 30% lower today than it was in 2019. Demand is still there. So, whilst I'm not expecting any kind of supply crunch that we saw post-pandemic, there definitely is going to be an imbalance, in my opinion, of supply and demand, which we're starting to see. So used car prices are starting to sort of go up slightly. Stock isn't easy to come by, but where there are good cars, they turn quickly and they turn for a good price. So hopefully we'll start seeing a little bit more of an uptick in finance penetration on used cars as well. It's sort of lower than it was. It's coming up, but it has been sort of subdued the last sort of year or so. So I would absolutely say that the outlook is an awful lot more positive than we saw in the first half of this year.
Yeah, yeah. Well, let's just pick up that theme then of price rises, Paul. I know that we've recently reported that trade values were, trade prices actually rose. In the retail sector, they seem to be, strong, not necessarily rising, but they seem to be very, very buoyant and very strong. What are you seeing at Black Horse, and what do you think is driving this pretty robust sector that we've got at the moment?
Yeah, I see the same numbers. The wholesale prices definitely coming up. There was beginning of the year, there was a big gap between wholesale and retail prices, and that's been narrowing all year, and particularly so in the last couple of months. So, the natural conclusion of that gap closing is that retail prices will increase because, as I was saying, the stock out there isn't as plentiful as it has been in the past, and so there is still high demand for those scarce cars. And so that inevitably is going to lead to an increase in sort of used car prices. Like I said, I'm not expecting double-digit growth, but we can see the turn is quick. The vehicles are turning pretty quickly. So the sort of the focus, I imagine, from the dealers is trying to source good stock that doesn't need a lot of work doing to it, so that we can kind of get those vehicles on the forecourts and to the customers.
Yeah, yeah, and of course, as more time goes on, more cars come under that 3 to 5 year age cohort, doesn't it? And then as we know, there's been intense pressure on that age cohort at the moment because dealers can't get hold of those cars, can they?
Exactly, and equally, the technicians that are needed to refurbish those cars are not easy to come by either. So there's a number of challenges in the market, which is why we're seeing the really good quality cars in wholesale are going for, the conversion rates at auction very high, the prices are higher than they have been, and that's sort of on an upwards trajectory. So there's a few things going on in the market that kind of are pointing towards, at worst price stability, but on the optimistic side, maybe a little bit of price inflation.
Mm. Are you seeing at Black Horse any increase in finance approvals for any particular models or makes of cars?
Yeah, so we're seeing quite steady approval rates across the board. We actually do see some increased approval rates, particularly in sectors where cash buyers are returning to the market. So, particularly when interest rates were a bit higher, and particularly in the new car space where the deals weren't plentiful. Your 8.9s, 9.9s have probably become 5.9, 6.9, and even lower in some cases. Then cash buyers will come to the market, and then we know they are generally the best quality customers out there. So we do see that. We don't see more customers falling into arrears. We see, Paul spoke about that. All those cost of living type of pressures are generally easing. The job market is holding up again. I'd say probably relatively well. With some spikes in there, but we don't see that materially changing. We don't see the cost of living outlook. Paul talked about inflation. I think that's a big piece of the puzzle. Wages now running above inflation. To do some of that catch back that had to happen when we had the really big inflation spike. So we don't. Again, I think where we don't see expected bounce in certain sort of application, especially the heartland, some of that 3 to 5 year old stuff. Some of that is just because there aren't enough cars there. We think there's great demand there, but those customers are being forced to either buy younger, and sometimes that's younger with a little bit more discounting, or older where those prices maybe hold up slightly better. So yes, we still see robust demand, but a customer that always bought a 3-year-old car has maybe this time had to look elsewhere, and it's maybe changed. But generally, I think the signs we're seeing are quite healthy, quite robust, which is encouraging, because I think that's a good sign of market health. So.
Yeah, absolutely. Of course, it would be great to get your views on rates. Lots of dealers are wondering what's going to be happening into the future. Are you expecting any changes in rates anytime soon? I know this is a crystal ball question, but early 2025. I mean, of course, we're all looking towards that period now. I mean, what are you expecting?
Yeah, I'll jump in on this one. So yeah, we are expecting some rate cuts. So into 25. In the immediate future, we're seeing volatility. We've got budget announcements, some high borrowing, high taxation, uncertainty around, is that going to be for day-to-day spending? Is it going to be infrastructure investments? So these are the things that typically concern the market and lead to swap rates going up and down. So we are seeing volatility, but the medium-term outlook, so into next year, the current latest estimates are that we're expecting a couple of cuts in the base rate, or unless something unexpected pops up. And we have seen recently, up until within the last week or two, we have seen some drops in the money markets for interest rates. So the outlook, I'd say, is probably on a slow downward trajectory. We're not going to see a big cliff edge. We're talking a couple of rate cuts rather than a sustained period of rate cutting. But I can say with a reasonable degree of confidence, we're certainly not planning on any increases.
Yeah.
So,
Carry on.
I was just going to say, I mean, I think the one thing that will be welcome news is that those Bank of England cuts are usually those usually flow fairly directly to dealer stocking rates, and that's I know something where we do see some pressure in the market. The amount of dealer failures is up on what we've seen, let's say 12 months ago. So I think that's something that would be really welcome relief for the industry, and that's something that can help. I suppose as Paul said, the customer rates are probably more of a longer term sort of grind lower, rather than some immediate relief, which dealers should hopefully get if the Bank of England moves in the next sort of three to 6 months.
Yeah. Well, that was going to be my next question, actually. I mean, what does this all mean for car dealers? So generally, I mean, it could be a bit of good news for dealers and just take a little bit of pressure off them.
Yeah. I think so. I think the point I made about the stocking stuff is valid. On the new car side, I don't think rates. I think rates already come down quite significantly this year on the new car side, and that's probably already happened a little bit. So will they go lower? Not materially. Used car rates will probably reflect more of what the money markets will do. Yeah, Paul, I don't know if you've got anything to add to that.
No, and I wouldn't add anything to it. What I would sort of say, James, go back to your earlier point around the market in Germany and prices. What we are seeing quite clearly is some really good low priced EV stock out there, used EVs, right? Comparatively speaking. So what we are seeing is an increasing participation of dealers stocking used EVs. Still very, very small, relatively speaking, but those that are, we're seeing quite clearly they're the fastest turning vehicle, and they have the highest penetration rates of finance. So sometimes up to 70 or 80% finance penetration with the approvals to go with it, obviously. So to your question, and I think consumers really are, tuned into the fact that if you kind of have one of those low cost overnight tariffs, if you've got access to home charging, the cost of buying the vehicle is often less than a petrol or diesel equivalent now. So actually it's really compelling. So those dealers that are operating in that space, we're seeing with absolute clarity, it's not a close thing, it's a big, big gap of faster turning vehicles with improving prices, with great finance penetration, and a really compelling consumer proposition. So actually that's sort of an interesting development. And then from a sort of rates perspective, us as funders are looking to support that market with special campaigns. We talked before on these calls about some of the things we're doing on that, and actually we're starting to see that happen more broadly across the market now. So it's a good news story there in one small but growing segment of the market.
Yeah, absolutely. Lastly, I just want to talk to you about retention. Now, recently at our Car Dealer Podcast live event, a lot of dealers, there was a feeling in the room that retention of customers is a big problem in the industry, and it's still a big problem. Why do you think this is?
Yeah, so I think there's a couple of factors here. I think retention is not a new thing either. Everyone's been trying to retain their customers for as long as they've had customers. I think something that's changed sort of from the pre-COVID to post-COVID. The market was very competitive pre-COVID. The market's very competitive now, but customers have got more choice than they had then. They've got more brands to choose from. They've got more fuel types to choose from. They've got more finance options. They've also got more options of how to buy the car and where to buy the car. So the digital marketplaces or the ability to do more stuff online. So it's probably harder to engage with our customers, harder to get that share of voice. So in some ways, it's not surprising. It's not just about a case of sort of showing up and trying to do the best thing for the customer on the day. I think there's a big nurture point here as well. Is that customers, and we all know that if you bought something from someone and they never speak to you and you phone them 3 years later, you do take a bit of a cynical view of that, and yet often that's the behavior that we get ourselves into the trap of. So I think it's got to be at the forefront of everyone's mind, and you need a strategic view of it. It's about joining up with the OEM. It's about joining up with finance companies. It's about data. So data is absolutely crucial. You have to have that touch point and how you do that. So we're doing a lot of thinking in this space at the moment for how we sort of come to the party better for dealers, how we engage, how we can use the power of Lloyd's Banking Group to help our dealer partners. But it's not a quick fix either. I don't think it's about skills. It's about all day, every day stuff, processes that happen, and some of these habits, in all honesty, we've lost during COVID because there weren't a lot of cars to sell, or there were fewer cars, and there were a lot of customers waiting. So in some ways, if you didn't do your retention, there was always a queue of customers, in theory, at the door to buy those cars. So I think it's a little bit of back to basics and a little bit of back to basics in the new world, probably. That's what I'd say.
Yeah, Paul, what do you think dealers can do to improve retention and and get those customer conversations going.
I think Preston touched on it. For me, the key is the data. So you've got to know your customers. You know that if they're not coming in and you're not seeing them as often as you once were, you know what we do have is an awful lot more data points. We've got connected cars. We've got the ability to marry those data points together using AI and machine learning. You know, really learn, you know, what works and what doesn't from a pure kind of data perspective, so that those conversations that you are having are much more likely to lead to a conversion or a sale or whatever. So actually, I think that's good. And then from a sort of brand perspective, you know, what I think is important is, you know, that there's always been a sort of questionable brand loyalty, but what we are seeing is as new brand entrants come in, or different brands from existing OEMs. So, for example, moving a Golf to an ID range or whatever. Yeah. You know, I think the dealer's got a really good role to play there in explaining all of that, and sort of it's an excuse to start a conversation, which isn't straight in with a sale. So I think actually the relationship side of things, married to the data, married to the conversion, I think it's really, really powerful. And a week doesn't go by at the moment without some new data visualization tool or AI, this, that, or the other, that can kind of help with the interaction. So I think we're going to see a huge sea change in that capability in the next 12 months. And hopefully we'll see the corresponding sea change in retention as well.
Mm. Fantastic. Well, some really pertinent points there, and it's nice to get your views on what's going on in the industry at the moment. Paul, Preston, thank you very much for joining us today.
You're welcome. Thanks a lot.
Well, that's it for today's Car Dealer Live. Join us again very soon. Bye-bye.